the main actions I've been watching in this cycle between fear and greed were company actions, and companies have been retrenched for most of the cycle. But we expected mergers and acquisitions to pick up, and I expect capital spending to pick up. M&A has definitely picked up, and it's very rational. Interest rates flatter assets. Jim Grant calls it interest rate goggles, and I think there's an aspect to it. But companies are acting very rationally. If you look at the where fixed income is priced relative to equities, fixed income is very expensive, meaning companies can issue cheap debt and very accretively buy cash flows in other companies. So it's very rational that M&A is coming back, and it is in a big way. Capital spending's been lagging, and so they've been very reluctant to put cash to work for organic growth opportunities. We're starting to see that slowly change, but it's been slower than I would have thought. So capital spending in the first part of the year was up high single digits year on year, and it was really running zero or down. So we've seen a little bit of an inflection there, but it's still below normal levels. And I think that's going to heat up also. And that's going to change things because profit margins got so high this cycle, companies have been focused on return on invested capital. They haven't been focused on growth. But now that you're making bigger investments in the future, that will slowly pressure profit margins, and I think the game will change. It's good for the real economy. It's good for labor. This is what the Fed wants to have happen. These are what everyone wants to have happen, is to drive a real recovery to make more bets on the future. And it's happening. It just makes my job tougher.